Chapter 1. The Definition of Enough. Meet Jason, software professional, $160,000 salary, modern apartment, luxury SUV lease, the newest tech every fall. On paper, he's winning. But 3 days before payday, his account balance dips below 4 digits. Credit card balances rotate quietly. Savings? Minimal. Emergency fund? Almost non-existent. Now meet Olivia, marketing strategist, $75,000 salary, paid off sedan, keeps her phone until it dies. She travels. She enjoys life. She isn't extreme, but she has 6 months of expenses saved. Her net worth is growing steadily. The difference begins with a single question. How much is enough? Most people never define it, and when enough is undefined, lifestyle expands endlessly to match income. Psychologists call it hedonic adaptation. You adjust upward, you normalize quickly, you chase again. If you don't anchor your lifestyle, your income becomes a treadmill. The first rule of wealth isn't earning more. It's defining the point where more stops changing your life. Chapter 2. The second price tag. Every purchase carries 2 prices. The first is printed. The second is invisible. Opportunity cost. A $400 monthly car upgrade invested over 25 years at average market returns can compound into hundreds of thousands of dollars. Streaming subscriptions, food delivery, incremental upgrades. None feel dramatic individually, but compounding doesn't care about feelings. It only cares about time. The wealthiest thinkers don't ask, "Can I afford this?" They ask, "What would this money become if invested?" When you begin seeing the second price tag, spending becomes intentional, not restrictive. Intention. Chapter 3. Identity and invisible pressure. Open your last 15 discretionary purchases. Now ask, would I still buy this if no one would ever know I owned it? Human beings are wired for social comparison. Status signaling is subtle. It hides inside upgraded cars, renovated kitchens, brand name tech. But here's the truth. The audience you're trying to impress is busy performing for their own invisible audience. Identity spending scales with income. The more you earn, the more expensive the performance. Real wealth builders detach purchases from validation. They buy for utility and joy, not for applause. Chapter 4. The 72-hour rule. Impulse thrives on urgency. Limited stock. Sale ends tonight. Only 3 left. Retail architecture is designed to bypass logic, but urgency fades. Most desires lose intensity within 48 to 72 hours. Create a simple firewall. Any non-essential purchase over $75 waits 3 days. No exceptions. Not because you're depriving yourself, but because clarity arrives after emotion fades. Distance restores control. Chapter 5. The upgrade trap. Modern culture promotes upgrading as progress. New phone every year, new car every few years, new furniture when bored. But replacing something functional rarely improves life proportionally to its cost. Before replacing anything, ask, is it broken beyond repair? Does the new version change what I can actually do? Is keeping it costing me more than replacing it? If not, you're not replacing, you're refreshing. Over decades, refresh cycles silently erode 6 figures of potential growth. Chapter 6. The domino effect. One premium purchase often triggers a cascade. New couch makes the rug look old. New TV makes the room feel outdated. New phone makes other devices feel incompatible. Lifestyle coherence pressures everything upward. Before any major purchase, ask, what else will this make me want to change? Wealth leaks don't start with recklessness. They start with momentum. Chapter 7. Subscription drift. Small recurring payments bypass psychological alarms. $12.99, $14.99, $9.99. Individually harmless, collectively powerful. Many Americans underestimate subscription spending by more than half. The simplest reset? cancel every non-essential subscription, then reintroduce only what you genuinely miss. Inertia built them, inertia can remove them. Chapter 8. Raises and Lifestyle Creep. Income increases feel like progress, but if expenses rise at the same pace, wealth doesn't move. When you receive a raise, capture it before you experience it. Commit at least 70 to 75% of income increases directly to investments. Behavioral research shows that pre-committing future raises dramatically increases long-term savings rates. The version of you before the raise was already surviving. Let the raise build assets, not habits. Chapter 9. Automation over willpower. Willpower fades with fatigue. Architecture does not. Automatic investing on payday, retirement contributions tied to percentages, emergency savings at a separate institution, bills on autopay. When savings happens first, spending adapts. When savings happens last, it disappears. Wealth builders don't rely on discipline, they rely on design. Chapter 10. One metric that matters. Budgets fail because complexity overwhelms. Instead, track one number: savings rate. Money saved divided by gross income. If it's increasing, your financial position is strengthening. If it's falling, lifestyle is expanding too fast. A 20% savings rate builds stability. Higher rates accelerate freedom. Simplicity sustains consistency. Chapter 11. Money as life energy. Divide your monthly take-home pay by 160 hours. That's your real hourly rate. Now translate purchases into life hours. A $1,000 device may represent a full week of your time. A $900 monthly car payment could equal over a week of work every month. Some purchases pass this test. Many do not. Money is stored labor. When you spend it, you are spending pieces of your life. The question shifts from, is this affordable, to, is this worth my time? Chapter 12. The Freedom Horizon. If your income stopped tomorrow, how long could you maintain your life unchanged before disruption? 2 weeks? 1 month? 6 months? That timeline is your freedom horizon. Research consistently shows even modest emergency savings dramatically improves psychological well-being. Because stability isn't about income, it's about margin. 6 months of expenses creates psychological silence. The background anxiety quiets. Decisions improve. Confidence stabilizes. That's financial peace. Epilogue. 2 paths. Jason isn't irresponsible. He simply followed cultural defaults. Olivia isn't extreme. She followed rules that compound. Wealth rarely arrives dramatically. It builds quietly in the background of disciplined decisions. High income without structure creates pressure. Moderate income with systems creates freedom. The difference isn't luck, it's awareness. And now you have it. The question is simple. Which path are you currently building? Because income doesn't determine wealth, behavior does. And behavior, once understood, can change.